For the very first time in its history, the Bank of Canada has given us an inside look as to how they make their decisions by releasing notes from their recent big meeting where the head honchos of the Bank of Canada, otherwise known as the Governing Council, decide how they will use their tools to manipulate the Canadian economy. Now, we already know that the Bank of Canada chose to raise rates by 1/4 of a percentage point, but given the new release of how they made their decision, I've gone through these meeting notes and put together 5 of the biggest surprises, predictions, and previously unseen insights from the Bank of Canada, so let's dive right into it. These are the notes that were released just yesterday. The title is Summary of Governing Council Deliberations, Fixed Announcement Date of January 25th, 2023. They make the title sound super dry, and that's why I go into these articles and find all the most important information for you. So if you haven't already done so, make sure to subscribe to this channel to keep on getting updates like this one. First thing we need to talk about is how the Bank of Canada was surprised by just how tight the labor market is. If you're unfamiliar with these terms, when a labor market is tight, that means it's hard for businesses to hire employees. Generally, people will say there's a labor shortage when their labor market is tight, but if there's looseness or slack in the labor market, that will mean that it's hard for people to get a job, but relatively easy for employers to hire people, right? The reason they were surprised by and are worried about this labor market tightness is because this labor market tightness can have an impact on whether or not inflation sticks around for the long run. Here they said that the Governing Council viewed this as a symptom of an economy that is still in excess demand. Overall, they concluded that the wage momentum was plateauing in the range of 4 to 5%. That's what we've been seeing over the past 6 months or so, that the year-over-year wage growth in Canada is averaging between 4% and 5%. They said that this persistent wage growth in this range between 4 to 5% is not viewed as consistent with achieving their 2% inflation target unless productivity increases to well above its historical trend. Let me explain what that means. They're essentially saying that the reason the labor market is still so tight is because the Canadian economy is still in a position where there is excess demand, meaning people still want to buy more goods and more services than are available. Now, that will generally mean that businesses need to hire on more people to make more goods and to do more services in order to meet that excess or heightened demand. And they're saying this is a problem for them because if wage growth sits around 4 to 5%, they view that as inflationary, because if businesses pay more to individuals to work for them, they also need to pass on those increased costs to consumers and raise the prices of their goods. So they're saying if we keep on staying in this area where wages are growing between 4 to 5%, that's not consistent with getting back down to 2% inflation, which is the Bank of Canada's overall main goal for everything. They say that's a problem that is unless productivity increases to well above its historical trend. They're saying, well, we can't see 4 to 5% wage growth if we're not also seeing a 4 to 5% increase in overall productivity in the economy. The Bank of Canada is saying if people are actually more productive and are contributing more to the economy in dollar terms, well, they're saying if they were 4 to 5% more productive, then a 4 to 5% wage gain wouldn't be inflationary. But because we're not seeing that increase of productivity at the same time that wages are going up, they're worried that this is going to have a bigger impact on inflation. And I know a lot of people are going to be pissed off hearing this, with many people frustrated that wages still, even at that 4 to 5% increase, aren't going up fast enough to combat the rise in cost of living, and there's actually numbers that will back you up on this frustration. Oftentimes we use this number, the GDP per capita, to measure the average person's productivity in Canada, and we've seen that actually go up significantly over time. Between 2001 and 2021, the average GDP per capita has gone up by 117%. But at the very same time that we've seen this doubling of productivity on a per person basis, when we look at the same period of time, 2001 all the way up to 2021, and we look at the average usual hourly wage in Canada, we can see that that's only increased by approximately 20%. So simultaneously, we have a 117% productivity per person increase, while wages have only grown by 20%. That's what caused all of the criticism back in November when the head of the largest union in Canada, the head of Unifor, said that the Bank of Canada was essentially declaring class warfare on working Canadians by saying that they can't have the wage growth that would sort of bring them back in line with the amount of productivity growth that we've seen in Canada. The next thing the Bank of Canada was surprised by, the second thing here, was inflation. They weren't necessarily surprised with this number, 6.3% inflation, the number we saw at looking at December's inflation when we looked at that data that we got in January. They weren't so much surprised by this number per se, but surprised by the numbers that went into making this number. They took a hard look at something called prices for durable goods. Durable goods refer to like things that people in Canada will buy that will last for a longer amount of time, like 2, 3, 4 years long. You're gonna buy it and it's gonna last for that long, as opposed to sort of short life cycle products, like things that you'll sort of go through, like maybe garbage bags or aluminum foil or something like that. Although, come to think of it, I think I've had the same aluminum foil roll for the past 5 years. Even switching houses and stuff, I have the same one. So maybe that would even be considered a durable good in this situation. For durable goods, household appliances, and for passenger vehicles, we're seeing a decrease in the rate of inflation, and this decrease is speeding up. Now, prices aren't decreasing in these areas, but the year-over-year inflation that we're seeing in these areas is decreasing when compared to the previous month. Like back in December, we saw 5.3% yearly growth in durable goods, and now we're only seeing a 4.7%, so that's a downward trajectory, getting closer to that 1 to 3% range that the Bank of Canada wants. In household appliances, we saw it go down to 2.8% price growth over the year, as opposed to 7.4% when we compared this last month. And similarly, in passenger vehicles, we're seeing this decline in the growth of the prices, but prices are still going up, and the Bank of Canada wants to stop that entirely, bring it back down to 1 or 2%. So in the Bank of Canada's eyes, they're saying, okay, thank God, here's a signal that inflation is starting to come down in Canada. But at the same time, they are still afraid of one specific category where inflation isn't slowing down and it's remaining rather stable, and that is in the prices of services in Canada, as opposed to goods, the services that you would hire someone to come in and do, maybe to clean your property or mow your lawn, these types of services, right? And they said inside of their monetary policy report, service price inflation could also remain elevated if labor costs rise more than projected. We talked about that a little bit already. Growth in labor costs is about 5% on a year-over-year basis. In the projection, growth in overall labor costs moderates to fall in line with a 2% inflation target. Services price inflation could be more persistent than projected if productivity growth rebounds more slowly than expected, or if the labor market remains tighter for longer than anticipated. Getting back to the things we talked about with the labor market, they're worried that the cost of these services, because it's so dependent on the cost of the labor for someone to do these services, as opposed to goods where the costs are more related to commodities and how much it costs to build the thing. This is so much more related to labor costs. So if labor costs continue to go up as they're seeing at the 4 to 5% range, then they're really worried that service prices are going to remain high, and that's going to contribute to higher inflation. People are going to have to pay more money for these services. And the governor of the Bank of Canada, Tiff Macklem, actually talked about this specifically in a press meeting that he had just yesterday. Let me show you.
What's going to take longer is service price inflation, and that is more directly linked to the tightness in the labor market and the increases in labor costs we're seeing. And I will certainly admit that there is more uncertainty about how quickly service price inflation comes down. What we are seeing, though, is we are seeing that the effects of the rapid interest rate increases that we've already put in place, we are seeing that they are working through the economy. And our own forecast is that growth is going to be roughly zero for the next 2 or 3 quarters. What that means is over that period, the economy, supply will catch up with demand in the economy, and the economy will move from clearly being in excess demand to some modest excess supply. That should relieve those price pressures.
So he explains the impact of higher service prices, but then he also explains how they hope this will sort of sort itself out. And that leads into the next point that we're going to talk about today, which is that the Bank of Canada is now predicting that they've been forceful enough, and that we're going to see the impact of how forceful they've been in raising interest rates in the coming quarter, saying, hey, we haven't felt the pain yet of what we've done. We've seen it a little bit, but there's more to come. And this comes from this paragraph here inside of the minutes from the meeting that were released. They said all governing council members acknowledged that they were approaching this decision with a similar view. Everyone in the council thinks the same thing, and that is that monetary policy to date has been forceful and that the full impact would be felt in the quarters to come. The sectors of the economy most sensitive to interest rates have clearly already responded to tighter monetary policy. Now, they're talking about like real estate here, things that are heavily impacted by interest rates, because if interest rates go up, you can't get as large a mortgage, and that pushes real estate prices down. They're saying that those sectors have already responded, and evidence is starting to appear that the other parts of the economy that are sort of lagging more, it takes longer for the Bank of Canada's interest rate hikes to impact them, while those sections are starting to see the impact. They're beginning to respond. And this lines up with the Bank of Canada's other predictions for how the economy is going to fare over this next year. They've said that, okay, we haven't felt the full impact of this yet. And that lines up with what they've said in that Canada's not going to have any GDP growth, or they're expecting right around 0% growth in the Canadian economy, which would typically in normal times be an absolute disaster, right? You need the economy to keep on growing for people to have a growing quality of life in Canada. But right now, the Bank of Canada is actually engineering us to have less growth in the economy and bringing out the demand from the economy that they believe is causing all of the inflation that folks are struggling with. Now, we actually got insight about what the Bank of Canada really thinks on housing in Canada, because they've now for the first time released the minutes from this meeting. They say with respect to the housing market, there was concern amongst the members of the governing council, the head honchos of the Bank of Canada, that the tighter monetary policy, higher interest rates, could be larger than expected. The impact could be larger than expected. If they're right in saying we haven't fully felt the impact of their raising interest rates, then it's likely that house prices have further to fall as consumers get stretched more thin and have less money to pay for things, maybe even leading some people to list their homes because they can no longer afford the mortgage payments. But the Bank of Canada says we don't need to worry about this too much. They're sort of saying, take it easy, this isn't going to be a disaster, because they recognize that continued strong immigration and household formation would provide underlying support for the housing market, and also expectations of future monetary policy easing could also spur buyers to re-enter the market. So essentially that's two things. Because Canada has incredibly high immigration targets of around 500,000 new Canadians every single year being added to the country, well, that's going to supply this sort of bottom for the real estate market. It won't go below a certain point because we got more people who need more houses. And on top of that, they're saying if people start to speculate on what we as the Bank of Canada do, and when we're going to lower interest rates again, people could preemptively try to get into the real estate market before we lower interest rates and cause another housing boom. But in their recent monetary policy report, the Bank of Canada said we actually expect house prices to continue declining for the first 2 quarters of 2023, meaning that they sort of see house prices bottoming around the beginning of the summer this year, although they do say, okay, immigration, that should be the sort of help we need to make sure we don't bottom too far. The fifth piece of new insight that we got from the Bank of Canada is how they actually go in to make their decision as to what they're going to do to manipulate the economy using their tools, the main tool being interest rate increases. The big decision that they were making this time was whether or not they should just leave interest rates how they are or raise them by 0.25% or a quarter of a percentage point. We all know now that they chose raising interest rates by 0.25%. But this was a very controversial thing, right? Because the Bank of Canada is worried that if we raise interest rates too far, then we could see a longer and more prolonged recession. We don't want to create that kind of pain in Canada. That's what the Bank of Canada is thinking. But at the same time, they're also thinking, well, if we don't raise interest rates enough, we could just have inflation come back in, and then we'd have to raise interest rates even more to fight down that new inflation. They said the case for leaving the interest rates at 4.25% was that developments with respect to both the economy and inflation were beginning to move in the right direction, and that it's just going to take some time for what the Bank of Canada has already done to come into effect. This is why some people in the governing council said, no, we don't need to raise it anymore, we're just going to pause it. This is especially interesting when you consider the controversy around the Bank of Canada and the error that they made back in late 2021, early 2022, was that, hey, people were saying we're already starting to see inflation. Why aren't you raising interest rates already? The Bank of Canada has been criticized that they didn't raise interest rates quickly enough, and as a result, they had to deal with even more inflation than they would have had to. Now, the same argument can be made today that the Bank of Canada isn't stopping its interest rate hikes soon enough to prevent the economy from going into a prolonged recession. But ultimately, we know they raised interest rates by 1/4 percentage point, and they said that that was largely due to these two things: the fact that the labor market was so tight, like we already talked about, and the fact that third quarter GDP growth was stronger than expected. They were predicting low to no growth in Canada, and we actually saw around 2% growth in that quarter, I believe, if I'm remembering my numbers correctly. In any respect, they saw more growth in the third quarter and are expecting to see more growth in the fourth quarter than they anticipated. So they're saying, okay, well, we better actually raise things up another 1/4 percentage point because we're not convinced that we've done enough at this point. Because ultimately, the Bank of Canada is more afraid of long-term inflation or inflation coming back again than they are of putting the Canadian economy into a recession. They think it would be worse for us to see inflation again than whatever recession we could be facing now as a result of them raising interest rates. They want to avoid a double-dip recession. If you're not familiar with that term, the idea is that we see this sort of recessionary pressure from the increased interest rates, but if they don't go far enough, then inflation could come right back and they have to do even more, causing that sort of second dip in the double dip, like a double dip recession. The first one, inflation comes back, and then we just get another recession. And this whole period where we're in a recessionary environment is prolonged far longer than it would have been if they just dealt with inflation the first time. So that's why they went with that 0.25% rate hike. So those were the 5 key insights, but I want to provide you with one extra bonus one, the one that I actually find the most interesting, because inside of these notes, we found out that the Bank of Canada actually does view the words it says to Canadians as one of its policy tools. The words they say have an impact on the economy. It's not just the raising or lowering of interest rates, it's how the Bank of Canada talks about what they could do in the future. People familiar with the channel will know that I talk a lot here about the impact of forward guidance or future guidance, what the Bank of Canada says or projects that it's going to do. In these meeting notes, we see that the Bank of Canada actually thinks really hard about their communication strategies for the type of language they use at their press conferences. They said that they want to convey that the bar for additional rate increases is now higher. They want to give a clear sense that they need a lot more data before they start increasing rate hikes again, sort of signaling a pause here for rate hikes. And they also say it's important that they're clear about the conditionality of any pause. Given inflation was still well above target, Governing Council could sort of raise rates again, but most of the sort of messaging that they gave here was that, okay, well, we're kind of pausing for the time being. You don't need to expect any more rate hikes from us. Now, that general sentiment would be a sort of loosening of monetary policy or signaling of future loosening of monetary policy. People sort of like the idea of this when they think about their investments or their real estate prices. If the Bank of Canada says, hey, in the future, or signals we're going to pause for now, in the future we could lower rate hikes, which is what a lot of people interpreted this as, well, then that could be positive both for people's investments, including their real estate and other sort of Canadian holdings that are impacted positively by lower interest rates. And you can see how much this matters to the folks at the Bank of Canada because as soon as this rate hike pause was announced about a week and a half ago, well, people on Twitter and different market participants started saying, hey, I think the Bank of Canada might actually start decreasing interest rates later in 2023. And the Bank of Canada said, oh crap, these people are getting the wrong idea from us. We don't want to signal that they should, that it's okay to go out and spend again. We don't want inflation to come back. So the Bank of Canada, in a press conference just yesterday, the same one that I showed you that clip from before, that's where Tiff Macklem said, hey, we're prepared to raise our policy rate further. We're not going to cut interest rates, sort of changing the communication or clarifying what they actually wanted to communicate. Here, the Bank of Canada Governor Tiff Macklem said market participants who interpreted his decision to take a break from raising interest rates as a prelude to cuts might be getting ahead of themselves. Now, I found that super interesting because the monetary policy, while it is about raising and lowering interest rates and whether or not you're quantitative easing or quantitative tightening, one of the tools is definitely the language and how they talk to Canadians and how they make Canadians feel. This is a more abstract tool, but I think a very interesting one. But those are the key things that surprised the Bank of Canada, the predictions they made, the new insights we got, and we covered a lot of different things. We covered labor market tightness, we covered the latest inflation numbers, we covered housing, and I'm curious what you think about all these different things, let me know down in the comments. I read every single one and I reply to a bunch of them. If you haven't already subscribed to the channel, make sure to do so you keep on getting these Canadian updates right on your YouTube page. And with all that said, thanks so much for watching, everybody. Really hope this video helped you out at least a little bit, and I'll see you next time.